In this video, I'll break down the ICT Classic London Silver Bullet strategy. This is one of the easiest trading models you can use, and it only requires two concepts: liquidity and fair value gaps. It's simple and very powerful, so let's get straight into it. In the previously explained videos, I showed you how to use the ICT Classic Silver Bullet strategy during the New York AM session. As I mentioned earlier, there are three specific one-hour time windows during the day where the Silver Bullet strategy can be traded. I have already explained the New York AM session in detail, and now, in this video, I am going to explain how to use the ICT Silver Bullet strategy during the London session. First, let me clarify the exact timing for the London session Silver Bullet. The one-hour trading window for the London session is from 3 a.m. to 4 a.m. New York time. This is the only time window during which this strategy should be traded for the London session. It is very important to understand that the ICT Silver Bullet London session is traded strictly between 3 a.m. and 4 a.m. New York time, and no trades should be taken outside of this specific window. Another important point to understand is that this strategy is not based on trading a single fair value gap in isolation. Bias and draw on liquidity play a critical role in the Silver Bullet strategy. Before looking for a fair value gap to trade from, you must first identify a clear directional bias. Without bias, trading fair value gaps alone significantly reduces the probability of success. Once bias and draw on liquidity are clearly defined and aligned, only then do we look for a fair value gap to execute the trade. With that understanding in place, let me now explain the exact rules of the ICT Silver Bullet strategy for the London session. There are a few important rules that must be followed when trading this strategy. The first rule is related to the instruments we trade. ICT himself recommends using this strategy on three specific pairs. However, trading all three at the same time is not ideal, especially for beginners. From a risk and execution management perspective, it is much better to focus on a single pair and master it properly. For that reason, in this video, we are going to trade only one pair, which is the euro. The next rule is related to timing. We must trade strictly within the 1-hour time window that I mentioned earlier. This does not mean you only have 1 hour for the entire trade to play out. What it means is that your entry must occur within that specific 1-hour window. You are allowed to hold the trade beyond the time window if necessary. Now, the question is how long we are allowed to hold the trade. For the London session Silver Bullet, the trade can be held until the London session closes, based on New York time. To summarize this clearly, we must enter the trade between 3 a.m. and 4 a.m. New York time. If the trade does not reach its target within that 1-hour window, it can still be held until the London session officially closes. The next rule is related to fair value gaps. We do not trade any fair value gap that forms outside of the 1-hour time window. We must wait for price to form a fair value gap during the defined session window. The fair value gap can be from any time frame you prefer for entries. The specific time frame does not matter, as long as the fair value gap aligns with your directional bias. Once the first fair value gap that aligns with the bias forms, we place a limit order at that fair value gap. After placing the entry, the stop loss is set at the high or low of the fair value gap, depending on the direction of the trade. If the trade is bearish, the stop loss goes above the high. If the trade is bullish, the stop loss goes below the low. For take profit, we follow one strict rule. We only target a fixed 1-to-2 risk-to-reward ratio. We do not target more, and we do not target less. Consistency is key with this setup, and ICT himself emphasized targeting a 1-to-2 risk-to-reward for the Silver Bullet strategy. The final rule is simple but very important. You must not add unnecessary rules, indicators, or modifications to this setup. There are also basic trading rules that every trader should already be following, such as proper risk management and discipline. Do not break those rules, and do not overcomplicate this strategy. If you follow these rules exactly as explained, the strategy remains clean, structured, and effective. Next thing I want to talk about is risk management. There are basically two approaches to risk management, and I'm going to explain each one. According to your personality, most traders have two choices: One is to pass the evaluation fast, and that comes with the downside of breaching the account quickly as well. Others want to go slow, take low-risk trades, and keep their trading account active for a long time. Both approaches have their own pros and cons. The slow approach can make you feel like your time is being wasted and like you're not seeing results. Both have their strengths and their negative sides. You have to choose one based on your personality. That's totally up to you. So basically, I'm giving you both approaches, and you have to choose one based on your personality. Let me explain the first approach, the aggressive approach. With this type of risk management, we're going to risk 2% per position, and I don't want you risking more than 4% in a single day. That means if you take 2 losses in a row, you're done for the day. I also want you to close your positions once you make 5 to 8% of your risked amount. Now the conservative approach, or the slow approach. Here, I want you to risk 1% per trade, and I don't want you risking more than 2% per day. That means 2 losses in a day, and you're done for the day. Basically, in both cases, I want you to take only 2 trades per day. Same thing for profits. Once you make 5 to 8% of your risked amount, you're done. Now let's move on to the charts and look at some examples. Now let me show you some real examples of ICT Silver Bullet during the London session. So the first thing we're going to do is open the charts at 3 a.m. New York time and identify our draw on liquidity. For the draw on liquidity, if we move down here, we can see some unfilled inverse fair value gaps that we're going to target. Based on this, our bias is bearish. Now we're going to see if price is ready to move lower at 3 a.m. You can see we have a buy-side liquidity sweep and a previously respected fair value gap. Now let's see if price forms a fair value gap. I want a bearish fair value gap because my bias and draw on liquidity are bearish. And here you can see we have a bearish fair value gap right here. This is the first fair value gap after 3 a.m. Now we're going to place our limit order at the fair value gap, set the stop loss at the highs of the fair value gap, and target a 1 to 2 risk to reward. There's no need to target further below. That's it. Now let's see how it plays out. You can see how clearly price moved straight to our target and how easy it is to trade using this strategy. Let us look at another example on the charts. The process is exactly the same as before. The first thing we need to identify is our draw on liquidity. In this case, the draw on liquidity is this order block, which clearly gives us a bearish bias. Now that our bias is bearish, we move forward and wait for the session open. At 3 a.m. New York time, we check whether a fair value gap forms. As you can see here, we get a bearish fair value gap on the 3-minute time frame. This also highlights the fractal nature of the market, showing that this strategy can be applied on any time frame, as long as the rules are followed correctly. Once the fair value gap is formed and aligned with our bearish bias, we place our limit order at the fair value gap. The stop loss is placed above the high of the fair value gap, and the take profit is set at a fixed 1 to 2 risk to reward ratio. As you can see, price moves very cleanly and reaches our target without any difficulty. This example clearly shows the simplicity of the strategy and proves that there is no need to overcomplicate the setup. When bias, draw on liquidity, and timing are aligned, the execution becomes very straightforward. This is how you apply the ICT Silver Bullet strategy during the London session. That's it for this video. If this helped you, make sure to like the video and subscribe to the channel. If you want to join my mentorship program, the link is in the description. And for any questions or doubts, you can join my Discord. I'll see you in the next one.